Hello, everyone. Thank you so much for joining us. This is Andrew Berman from National Mortgage Professional Magazine, Mortgage News Network, coming to you from the Mortgage Leadership Outlook. Really appreciate you joining us today. We're going to give a couple of minutes for everyone to join us here. So right now, if you are joining us, if you're using your phone, make sure you use that little button so you can invite people, get other people involved in the conversation. Let us know you're here too. Please, if you're here, if you've joined us, click the like button, do something so I know that there's someone else watching this other than my mom and dad. So please click the like button. Just let me know that people are here watching this. I do see people piling in from all the different platforms we have. So if you haven't watched this before, actually we're available on Twitter. We're doing this on YouTube, and we're doing this on Facebook. So please let us know you're here. Click a like, give us something actually so we know that you are here joining us today. We'd really appreciate that. So if you see me over here looking at my phone, I'm not checking my messages, just inviting people, getting people started, so people come over here. And all right, fantastic. So good. We got some people joining us. Thank you so much, Maria Sousa. Thank you for joining us. Appreciate the acknowledgement. So with us today, I am so blessed to have as our guest Rick Sharga. Rick Sharga is the founder of CG Patrick Realty. CG Patrick Company. I'm going to bring Rick here, where I first became aware of Rick, which is actually, it's a kind of a fascinating thing and a fascinating story. I'm going to go into that because his and of course, no one has a typical entry into the mortgage business. But Rick, in 2008, was on the front lines of the foreclosure mess. Rick, and I always assumed because you were on CNBC, you were on Fox News, you were on all the major media outlets. It was always my assumption that you were a career economist and real estate person. But it turns out actually that was relatively new to you at the time, right?
Yeah, I'm first of all, thank you for having me today. It's great to reconnect with you after all this time. I'm kind of an accidental tourist in this space, to be honest with you. I spent the first half of my career doing marketing mostly for technology companies. So, big companies like Toshiba and Fujitsu and Hitachi and JD Edwards and Cox Communications. So all sorts of big national, international companies. And I opened up a consulting practice after the dot-com bubble burst, and one of my clients was this little startup called Realty Track, which was under new management at the time, and planning to go from being a company selling leads, REO leads, to California realtors to becoming a national platform where investors could go to find information on foreclosure properties. And I'd only planned to stay there for a few months full time, and then reopen my consulting practice. When the CEO asked me if I would handle some interviews for the company, because we were the only ones who had a national database of foreclosure information who was willing to talk to the press at the time. Mortgage Bankers Association, of course, had been the gold standard for years in terms of foreclosure data, but really didn't want to talk on the record about what was going on in the market at the time, because they knew the press was not going to be kind to the mortgage industry. Excuse me. So by default, we started doing it, and honestly, that was kind of how I learned about real estate in the mortgage industry. I would be doing interviews constantly, and I'd get such good questions from reporters that I'd have to go do research on the subject to come back and answer the questions. But in a way, I think it was an advantage for me because not being a lifer, I really didn't think I knew all the answers all the time about what was going on, and was honest enough with my press contacts to tell them that. So it's been an interesting ride, and I still do a lot of work with the media, post a lot of information up on social media about real estate and mortgage trends.
And that's a fascinating thing. So you went to the media context and you say, I know something, I've got some good data, but were you were open and say, listen, I don't know everything. You might stump me, but I will find out the answers.
Well, ironically, a lot of people in the industry start out talking to the trade press and then go on to national media or broader based media. I kind of went the opposite direction because the trade press, candidly, knew more about the industry than I did, knew more about the processes than I did. And in some cases, I developed really good relationships with members of the trade media who helped me learn all those processes and kind of validated what I was saying. But yeah, I learned early on in my career when I was training CEOs to be spokespeople for their companies that the worst thing you can do in a reporter situation is pretend you know something you don't know and then get caught later. So there was a reporter for Reuters who used to be my first call every month on purpose because he asked the best questions. And I knew I was going to have to go find some information, but it was also going to help me color my thoughts for the rest of the month.
Wow, that's fantastic. So, I mean, and I got a bunch of questions I want to ask you, but one of the things we like to do on here is we're trying to encourage people to be leaders, you know, to be their own leaders. I mean, while we're having great leaders like yourself on here, we're trying to encourage our audience to be their own leaders, take some of the information that they're learning here and share it. And any, you know, any little bits of guidance, which, I mean, I know your career is based around this, but maybe a couple of pointers on how someone watching this can actually become actually a trusted resource for reporters. And any quick suggestions?
Everybody has expertise that's valuable at some point. I think the mistake people make when they're trying to create relationships with the press is they're trying to force their information into the media. Rather than view the media as a conduit for information to their readers or viewers. So the question you have to ask yourself fundamentally is, what is it that I have to say that will be interesting to this reporter's audience? Wow. And if you can become a go-to source for reliable industry information, but do it in a way that's of interest to the reporter's audience, not just what you're trying to sell that day, that really to me is how you build long-standing successful relationships.
Interesting. So putting the lens of that reporter on first, not and taking off your own lens, and seeing actually what's going to make them happy, make them look like a superstar. So that makes sense. So all right, let's pretend that this never happened. The coronavirus never happened. Where was housing headed towards? So let's say actually we go back to January. Yep. We wipe this thing clean, and let's say this passed this over like you know, like one of the other pandemics that no one seems to ever remember.
Well, it's Passover, so that's appropriate, I think.
Decent base, if applicable.
So. Yeah, we were actually we were looking at a pretty good year in the housing market. All the underlying fundamentals were good. We were creating jobs. Unemployment was at a 50-year low. Wages were actually growing faster than home prices. And miracle of miracles, even the builders appeared to be waking up from their long hibernation. So and interest rates were low. They were still almost historically low. So you had everything in your favor. The only thing that was keeping the market from exploding was that there wasn't enough to buy. There just wasn't enough inventory, mostly because of the builders underbuilding compared to demand, in part because some people in upper, middle, and higher levels didn't see a financial benefit in trading up anymore because of some of the tax laws that were changed, and in part because there's still a few million people who are actually underwater on their loans that, you know, 10 years into the recovery, who just couldn't afford to put their homes on the market. But if this hadn't hit, we had a really good January, we had a really good February. Pending sales were way up in February for March. We were looking to have a pretty healthy spring selling season. Purchase activity was strong. All systems were go. And in fact, in a bit of unfortunate predictions, I get out to talk to a lot of groups about the housing market. And I've been telling people that there was no wave of foreclosures on the horizon. The only way I saw the market slowing down is if we hit a recession. And the only way I saw a recession is if there was some sort of global catastrophe. So here we are. I have to learn to be more careful of what I talk about in these things.
We have you to blame for this. Then.
It's exactly my fault.
Oh, man. So let's look actually, and I know it's when we try not to do this comparison of 2008 to now, because it's just such a different animal and such a bigger beast on us. But let's talk about the government response, and let's talk about actually what we did wrong in 2008, and maybe what we tried to do right in 2000. 20.
So, boy, this could take a while. So, sit down and relax. One thing, just to go back to what I was talking about and kind of juxtaposing now versus 2008, the housing market was really strong right now, going into the pandemic. And in 2008, we had a market that was overbuilt. There were actually too many houses. We had properties that were grossly overvalued and unaffordable. And we had way too many borrowers in homes who were woefully underqualified for the loans that they got. And in many cases, we're sitting on ticking time bomb kind of loans that they got with teaser rates that were going to reset at rates that the borrower simply couldn't afford. So if anything went wrong in a market like that, it was going to be a disaster, and pretty much everything went wrong. In this case, we're entering into a downturn with all the fundamentals really being strong, good borrowers, more affordable housing, believe it or not, even though the prices have gone up, low interest rates, and a lot of equity, a record level of homeowner equity. So the market's better positioned this time to withstand a downturn than it was last time. The other big fundamental difference is last time we tried to use, there's a saying about generals always making the mistake of trying to fight the last war. We went into that last downturn in the Great Recession using absolutely the most antiquated, unreliable, and improper tools we could have used to try and correct the problem. I was talking to somebody earlier today, and I was reminded that I can't tell you how many consumers I heard from who went to their lender for a loan modification because they couldn't afford their monthly payment, got a modification, and the modification raised their monthly payment. Then the industry played surprised to know that that borrower wasn't going to be able to make any more payments. It was just, it was mind-numbing. So the big difference this time is we have government aligned with industry for the most part, and trying to prevent people from defaulting in the first place, rather than waiting for them to default and then trying to fix the problem afterwards. The latter is much, much harder to do, as any mortgage servicer can tell you, because as soon as that clock starts ticking, you have regulations from the CFPB, from Fannie or Freddie, from your state, from your national regulators, and there are just rules you have to play by. If you can keep people who really otherwise would be good borrowers and who would be performing borrowing payers from falling into default through no fault of their own, I think the outcome can be much, much better.
Interesting. So, but in this case, that outcome or the medicine that we used to potentially, if the forbearance plan is having some major impact on on housing, on mortgage lenders, servicers are scared. So let's talk about the worst case scenario with this unintended consequence. So let's say we have this the moral hazard of everyone says something it's bailout city. You get a bailout, you get a bailout. Everyone wants a forbearance. I got when they first announced it, I have two friends of mine that reached out to me. They're not mortgage industry. One of them owns a restaurant. I know actually he had very, very difficult times. Makes a lot of sense. The other one, I know he's very, very well off, very well positioned. Has no business actually getting a forbearance, but was asking me if I thought it was a good idea. So please actually talk about these unintended consequences and what happens if we see 25% of the loans that are being serviced get forbearance requests.
Well, and this is what I've heard, so it's third party, but pretty good sources tell me that there were some assurances made when this forbearance plan was being mapped out, that there would be a credit facility put in place for servicers. My back of the envelope math says that if your worst case scenario is right, and 25% of the 50 million borrowers with active loans paying $1,200 a month decide to take a 6-month forbearance, we're looking at servicers being on the hook for about $90 billion. And if that were the case, what used to be the servicing industry would be a smoking heap of rubble somewhere in a giant crater. There's servicers, and we can't, by the way, can't blame the servicers for not planning for this.
No.
They were in an environment where 0.5% of loans were in foreclosure, and about 3.5% were delinquent. You can't go from 0.5% to 25% and be expected to have enough capital to weather that kind of storm. Mr. Cooper, one of the biggest independent servicers, as of 2 days ago, had already received 86,000 forbearance requests. Fannie and Freddie, I believe the number's close to 1.5 million so far, but I'm sorry, that's not the right number. It's about 1.5% of their loans. So that actually makes me feel good, because if the moral hazard were real, I think we'd be seeing much higher numbers of people trying to take advantage of that right now. So there's a couple things to keep in mind. A lot of the forbearance requests are going to come from people, the legitimate ones are from people who either lost a job, got furloughed, had their income hit. The industries that were hit hardest were industries like retail, restaurants, hospitality, travel. None of those are high-paying jobs. And my suspicion is that home ownership rates among that working group are probably lower than average. So it may well be that a lot of the people who are being most affected here are renters rather than homeowners. So there may be a smaller buyer pool eligible for these programs than what we think. I've been telling people that if there's any justice in the world, when servicers later are putting together repayment plans and are now asking for documentation about your financials, there will be a penalty involved if you did game the system. Because this is supposed to be working on the honor system, and I'd love to see the powers that be come out with that kind of statement saying, hey, all you need to do right now is tell us you're having a problem and we'll honor that. But if we find out later you lied, there are going to be problems. And I think the other point you made is extraordinarily valid. You can't put a program in place where you're allowing people not to make payments without penalty and expect the servicers to foot the bill. And I think when I hear some of the cavalier comments coming out of Washington, even from some of the regulators who should know better, it makes me wonder if any of these people really know how the mortgage system works, and the interdependencies between the investors, the servicers, the originators. Worst case scenario, 25% of the population takes advantage of this. The system implodes and nobody can get a loan, and the housing market crumbles, and that leads to a broader recession. So, I mean, I don't want to be an alarmist, but yeah. Worst case scenario, I think that's it.
So, and listen, we've had a lot of people talk about actually, what are the options? Know your options. If anyone is not aware, if anyone's not paying attention to, there's so many great leaders out there sharing what you should be aware of. Can you talk to a little bit about the forbearance options that could be offered from the servicers out there, so our audience can share those with their people, with their community? Absolutely.
So there's a great resource up on the CFPB website. Yeah. If anybody follows me on LinkedIn, looks for my posts, you'll see I recently posted a link to that, and it walks through the whole forbearance program. But in short, if you're a borrower with a government-backed loan, so that means a loan that's owned by Fannie Mae or Freddie Mac, or that's insured by the FHA, the Veterans Administration, or the USDA, and your income has been impacted by COVID-19, you can qualify for a 6-month forbearance from your servicer. That's 180 days. And there's an option at the end of that to request a second 180-day forbearance program. And the government in this case is using forbearance the same way you would use deferral. So it's not our typical industry definition of a forbearance program. It means the borrower will not be asked to make any payments for some set period of time. No extra interest, no penalties, no negative reporting to the credit bureaus. And that accounts for roughly 60% of all active mortgages that are out there, of first liens. Borrowers must reach out to their servicer in order to qualify for that. They must request it. And again, I think at some point it's important to point out that there will be, when you're looking to put your repayment plans together, that there may be some financial investigation done, and hopefully people are being honest. In terms of the repayments, the government's outlined 3 potential ways to do this, one of which I think is going back to the bad old days of 2008 and that's to have a balloon payment due at the end of the forbearance period. So if you have somebody who's legitimately impacted by COVID-19, who's been out of work for 3 to 6 months, and you're expecting them to make a 6-month balloon payment at the end of that period, we're just kidding ourselves, and we're going to wind up with a lot of foreclosures. The other options are to tack the months to the back of the loan. So if you had 6 months deferral, you get 6 months extra at the end of the loan. Or there's the option of amortizing the deferred amount over the balance of the loan itself. So if there's 15 years left on the loan, you take those 6 months and you amortize the amounts over the remaining years of the loan. It's important for your listeners to also know that Fannie and Freddie have extended a similar program, different terms a little bit, but a similar program to investors who own rental properties. So if you own a rental property, I believe the terms, don't hold me to this, but I believe it's a 90-day forbearance with an option for another 90 days. And the expectation is if you get that forbearance, you will pass along that courtesy to your renters. So don't try and pocket the difference and not get caught. So those are the programs I'm aware of, and I do know that a lot of the major lenders, Bank of America, Wells Fargo, Citi, JP Morgan Chase, have announced similar forbearance programs. But what I do tell borrowers is, life's a negotiation at this point. Make sure you get the best deal for you, and make sure that you're not signing up to make a balloon payment at the end of this term that you can't possibly make.
Yeah, I mean, listen, to get started again with payments, once you have a few months of not having those payments, which is most likely going to be your biggest payment that you're making, that's just going to be a difficult thing. And then all of a sudden to have a big giant balloon that's going to be the last 6 months, it's just unlikely that that's going to be able to happen, especially actually if you were looking around for a job for some time. So know your options. And I think the other thing I keep hearing, well, yes, it's not supposed to be a ding against your credit report, but that lenders could possibly, because they're going to be able to see this, they're going to be able to see that there was a forbearance, maybe even if it's a modification, that could be a mark against you, even though it's not a derogatory credit item, but it could be a mark against you for the future. Is that have you heard that too?
Yeah, and I've spoken to some servicers who are trying to figure out if they were, for example, to re-amortize the deferred amount. How do they do a loan modification for somebody who's been out of work for 6 months? It's just usually one of the risk criteria that a lender or a servicer will look at when they're issuing a loan. So I think we're going to have to look at some extraordinary measures and some unusual circumstances as we're getting through the end of this pandemic. Right now, this is survival mode, just trying to get through. But again, I think all of this upfront activity will mitigate against having the worst outcomes. And I think we all have to figure out how to work within the rules, within these new rules, the new normal, if you will, when we're kind of coming out of this together. Yeah.
So let's say actually, we're not going to hit 25%, which it's unlikely that we will. And I appreciate you allowing me to play that doomsday scenario. But let's say so we don't hit 25%, and it goes kind of where we think it's going to be going, like the way the trend seems. What's going to happen to values? What do you think actually will be the hit on residential values?
That's a great question. In fact, it's about $1 trillion question. If you start doing the math, here's what I will tell you. I've just got done doing some research using some information from First American Data Tree, looking at home sales since the year 2000. And that covered 2 prior pandemics, SARS and the swine flu. And it covered 9/11, which was the closest proxy I could find to what we're going through right now economically, because everything just stopped. It didn't stop for as long, but it stopped. In all 3 of those cases, while we saw a dip in transaction volume, we actually didn't see a meaningful drop in prices. And a friend of mine, Mark Fleming, who's the chief economist at First American, just did a report on prior recessions. And with the exception of the last recession, which was caused by housing, in every prior recession going back to World War II, housing actually helped the economy get back on its feet. So prices improved from the beginning of the recession to the end of the recession. So I'm optimistic that if this doesn't go on too long, and that means that the majority of businesses survive,
Mhm.
which means the majority of employees get their jobs back. And the fundamentals were as strong as they were to begin with. I don't know that we're going to have a huge drop off in prices. There's only about 750,000 properties across the country that are for sale right now.
Hmm.
And so the lack of supply might actually protect values from dropping too far. I wouldn't be surprised to see a minimal drop, especially in some of the markets that were probably a little bit frothy to begin with. But nationally, I think what we're probably going to see is a slowdown in appreciation rather than an absolute drop. I could be wrong, but that's my optimistic position on it right now.
I wonder if actually if we can get a gauge, because China and Italy have already passed the curve. If we could see from them and take a look at their economies, to see actually how their recovery, what that start to look at, and if ours would resemble something like what China would have once they started. I'm not sure we can trust all the data from China, but that's a whole other conversation.
So if you look at data before, and Italy's too soon. They're not really restarting yet. What I can tell you is that the per capita ratio of dolphins in Venice is higher than it was before the pandemic because the water's cleaner. There's actually dolphins showing up in the channels in Venice, where the water had been just egregiously polluted before. Anyway, if you look at China and Hong Kong, which are probably the two first recovery areas, too soon to talk about pricing per se, but what we did see is transaction volume went off a cliff during the lockups, and even worse in China because they were coming off the Chinese New Year when transaction volume always falls, but it virtually stopped. And within a couple weeks of the lockdown being over, we started to see transaction volume picking back up. Now, I don't have information for you on pricing, but that's happened in both of those markets. And so if we're using them as a proxy for what we're seeing here, again, we can be hopeful that things won't be quite as bad. And by the way, anecdotally, hearing from realtors across the country, there are still sales going on. So we haven't gone to zero.
Yeah.
We certainly aren't where we were a month ago. And I expect transaction volume to be bad in March, to be worse in April, and to be weak in May. Just because right now in April is when people will be doing their final looks at homes and putting their mortgages in place to buy something in May. So I don't think we'll start to see numbers feel much better until maybe June. And that depends on how long most states are in shelter-in-place orders.
Yeah. Well, listen, I talked to a lot of people that had their best March. On purchase and refi. So and I'm talking to a lot of people that's still doing a lot of business, still closing stuff in April. So I listen, I don't know what our transaction looks like compared to China, or Hong Kong. I know actually, that we complain about actually how it's ridiculous how undigital we are right now, actually in the United States. But I've just always assumed that, maybe we're a little more advanced, and I don't know that that's the case, that we can actually continue to do some business, in spite of the liquidity crisis that we're dealing with, in spite of, knowing that, our unemployment numbers are just through the roof. I think, what do we have, like 13 million so far are the total tally, I think, so far?
Almost 18.
Oh, it's 18.
But again, fundamental big difference. If you look at these numbers, the majority of those workers have been told you're out of work for now, not forever. And in 2008, we had a weak underlying economy. We were losing jobs rather than creating jobs. And the people that were losing their jobs then weren't being told, just stick around for a month or so, we'll get you back in. They were basically being told your job doesn't exist anymore. So the spike was to be expected because we send everybody home. The recessionary numbers in our economy that you haven't heard about yet, but will hear about, are to be expected. They're going to be ugly because our economy is 70% based on consumer spending, and we just sent them all home. And all they appear to be buying right now are masks and toilet paper. So it's just, it's going to be a rough couple months. Nobody should be surprised by the numbers. And one of the other things the mortgage industry is facing is, and this is going to sound really weird, artificially high mortgage rates. If you look at 30-year fixed rate mortgages, and you track those along U.S. Treasury yields, if you look at that historically, they go completely in tandem. Right now, we have one of the biggest gaps in history between 30-year mortgage rates and the Treasury yields. And it's basically because the capital markets have seized up out of uncertainty over what's going on with all these programs. So as soon as that dust settles, I think we actually have a very good chance of seeing mortgage rates go down later in the year, which should be good to have people restart their refi businesses again.
Yeah, that's the best way to get us out of a recession is kickstarted with housing. So listen, as a top executive at Carrington, as someone actually who works with financial firms, what are the opportunities that you see right now or in the near future? And it could be things that your clients are paying you a lot of money to tell you that, and I'm asking you to share some of those secrets for free, in front of our viewers. But if you can tell us any of the opportunities that you see in the short term, it's difficult to predict the year, what's down there, but in the short term, what are the opportunities?
That's a difficult one. It's the opportunity. There are companies that are hiring. There are companies in the servicing and asset management space, and even originators who are hiring. The challenge is to know who still has access to warehouse lines, and who's going to have the liquidity and the capital they need to keep lending. I think the opportunity here is if I'm going to give you two thoughts. One is make sure you're visible for fallouts. So you're going to have a lot of borrowers who maybe were looking at a non-QM loan because they thought that's all they could get, but actually would qualify for an FHA or a VA or maybe even in some cases conventional loans, whose lender simply isn't lending anymore. You look at companies like Caliber and Angel Oak, and some other fairly large non-QM lenders. They've basically shuttered those lines. So there are going to be borrowers who thought they were ready to move, who suddenly need a fallback. So be ready for that. If you're running a company, or even if you're an independent mortgage broker or loan officer, one of the things I've learned over the years in all industries is that during a recession, the companies that make sure they stay visible during the recession, the companies that market their value proposition during the recession, typically gain market share when the market recovers. So if you have the ability to afford to do it, stay visible, market your products and services through this recession, you're actually going to come out ahead of your competition when the market turns. So this is a good time to be working on yourself, to be working on your business. I know Andrew and I were talking before this. He's supposed to be working on his home office, and he hasn't done that yet. But take advantage of the opportunity to kind of reconnect with your family, reconnect with yourself, work on yourself and on your business. That's an opportunity you may not get again in the next 30 years, and hopefully, and take a look at marketing yourself through this period if you can afford it, just to stay visible for when the market turns.
Okay, so no, first off, that was a private conversation. My wife is now going to give me crap because she's going to be reminded of the list of honeydew things that I was supposed to be doing. I said, actually, hon, this quarantine is going to give me a time to catch up on a bunch of the projects that you want me to do. So thanks for throwing me under the bus there, Rick. I appreciate that. But actually, what's interesting, you said something there, and man, I agree with you so much. I said this actually a couple of times this week. I said these next 6 months are how you set up your next 10 years. Yep. What you're doing in these next 6 months, and being out there, being a leader in your community, in your organization, in your family, and just taking actually all the time actually you can to kind of better your systems, just do everything you can, and just don't get sucked into all this negativity, which it's very difficult. Listen, you're in California, I'm in New York. It's everywhere. There's sick people and death all around us, and it's a horrible thing that we're dealing with. But the best thing we could do is just try to be actually as positive as we possibly can and informative. We want to be a realist here, but actually to be out there, just sharing as much information you can, and just think about, you know, the actions that you take over the next 6 months is what's going to set up the success or failure of you for the next 10 years.
Yeah, I couldn't agree with you more. And you know, my own medicine, I've been much more active on social media over the last few weeks. I'm publishing a report on how the housing market has fared through global pandemics in the next week. I'm doing interviews like this with you to try and stay visible. So I'm doing a lot of the same sorts of things that I'm recommending for people to do themselves. The other thing, just to kind of circle back to the forbearance programs, if you're a lender or a servicer in a position to help somebody during this period of time, help somebody. I was on a call a little earlier with a group of people, you know, kind of inside the industry people, and one of them said something along the lines of, well, I'm not required to give forbearance to my borrower, so I'm not sure I will. And I thought this is a great way to do exactly the wrong thing at exactly the wrong time. And I'm a big believer in karma, but I'm also a big believer that consumers know how to complain loudly. And if you want to screw up your reputation for the next 10 years, a good way to do it is to try and take advantage of people who are suffering because of the COVID-19 virus. So, you know, be a leader and do the right thing and help people that really need help if you have it within your bailiwick to do it.
So that's fascinating to get that mentality. That is a 2007 mentality.
It is.
So I mean, and one of the lessons that we learned, and so we could talk about actually all the bad things that Dodd-Frank brought about and how horrible actually the CFPB is. But one of the things that we have to recognize is we went from an industry that was focused on managing, basically you try to charge as much as you possibly could to be competitive and manage your risk. I mean, that was basically what your game. And then because of the CFPB, because of the changes that were made, we as an industry learned this new term about customer experience, and that being the most important thing, and making sure that your borrowers are happy, and not just happy, actually, you know, as in like they're not going to complain about you, but that they're excited about doing business. And so much to the point that actually now we have conferences. I talk about this all the time. Social Survey has a conference of people that are obsessed with customer experience. So, you know, that being said, you put those things together, we're in a place actually where that the thinking of that executive that you're talking about is just, that's a 2007 way of thinking. Those are people actually that are not going to survive, that are not actually setting themselves up for the future and to be the future leaders. So that's just, it's an amazing and a sobering statement. So listen, I know so much of your expertise is actually on the residential side, and really actually it's all people actually that were watching this are really going to care about. But you know, I'm curious about the commercial side, because I just have a lot of worry. I talk to a lot of people that mostly people that are in the mortgage business. They're saying productivity's through the roof. They feel actually that they will not have such a need for commercial real estate when we go back to the new norm, whatever that's going to be. So what are your feelings about commercial real estate?
Yeah, I actually agree with you. I think I'm concerned. I think commercial real estate's actually more vulnerable this time than residential, simply because of all the effort being thrown into the residential side of the equation. Excuse me, I'm also writing an article right now on winners and losers in the commercial real estate space coming out of the pandemic. Wow. I think the big winner is very likely to be the industrial sector. As people started to kind of be forced into more and more e-commerce, we were already seeing it grow, but I think the huge uptick in demand has highlighted some areas of the country where, candidly, there's probably a need for more warehouse and distribution capacity. Wow. So you'll probably see, as Amazon keeps trying to get closer and closer to an instant delivery of your order, you'll see more of that building up. And the fact that we're doing a lot more of these video conferences suggests you probably need more shared computing power. So you'll see warehouses or facilities go up for cloud computing. In addition, on the healthcare side, I think we're going to see fundamental changes in how we go about managing healthcare facilities and what kind of facilities we need. New York's probably epicenter for what could happen if suddenly you got an overflow, and how do you handle that?
We're always number one.
We've all heard the horror stories, and even manufacturing. There's a fear, a legitimate fear, I believe, that China at any point in time could basically shut off our access to antibiotics because they're all manufactured over there. So I think we'll see some movement toward bringing some manufacturing back on shore. So industrial, I think, is going to do really well. Retail, I think, is going to take. I think retail might be in for a bloodbath. There was a talk about the retail apocalypse last year. I think it was overblown. We see a lot of retail facilities being repurposed into multi-use facilities. I think we'll continue to see that. But look, there were a lot of big box and mid-sized retailers who were in trouble financially before this. One of my son's favorite stores, GameStop, where you buy a lot of your video games, closed 300 units last year, was planning 300 more this year before the pandemic. So retail chains like that, how many are not going to survive this downturn? What does that do to your space? And hotels, I think, will come back. I think hotels have probably been the hardest hit. I got a note where the chairman of Hyatt was saying they were off by 90% year over year. Hard to keep your business running like that. So I think we'll see a downturn in hotels. I think values in hotels will come down quite a bit, but it'll recover. And the one you talked about is kind of the one that I'm fascinated about. It's the office sector. You look at an area like Manhattan. You look at a place like Silicon Valley. And Silicon Valley in particular, you'd think would be one of the first adopters of telecommuting because of all the technology up there. And yet, try and get anywhere in San Jose at rush hour, and rush hour lasts 4 hours in San Jose. So you get done with the morning one just in time to hit the evening one on the way home. All these companies have people working from home right now, and where you have expensive real estate, and in a lot of these companies' cases, you have personnel and benefits as your primary expense, and then it's overhead. I do think we're going to see a shift. It might not be immediate because you still have leases in place, but I definitely think we're going to see a shift in the office space of the future. Probably going to look a little bit different than the office space today.
Yeah, it's an unfortunate thing to know that, but the flip side of that is the long-term productivity gains that we could see as business owners. So I'm trying to focus on the positive side, and I've talked to a lot of people that are just saying actually that their people are working harder. They're doing actually more than they could have, and especially for organizations that always felt that you had to be belly to belly. I mean, I've heard that term so many times. You got to be belly to belly, so actually, and I hear about the listen, because if you're not in the same office, you don't overhear the conversation over there that you happen to be an expert about something and can add something to that conversation. But something, the fact is, you're at home, you get to focus actually on your work when you're focusing on your work. And when it becomes time to have a social time, it's, we're getting good at doing these group huddles, using Zoom to kind of have conversations. We do actually like our own Ambiz team that kind of does all of our publications. Every day at 2 o'clock, we have our coffee hour. And Thursdays, we have actually, it's a beer Thursdays on top of the coffee hour. So it's amazing. We communicate more now than we actually have before. So
we're definitely going to see some opportunities for technology companies to provide distributed work environments. The other thing we could see that could be an upside for the commercial space is you could see more growth in secondary and tertiary markets. There probably is an option somewhere between everybody working in the same building and everybody working at home. And for a lot of companies over the years, they've kind of pushed everybody into expensive facilities and centralized locations. But what's to say you couldn't have 4 smaller offices instead of 1 huge office, and still give you that opportunity to lower your costs, have more flexibility in terms of geographic locations, and give people the flexibility that they need to be where they need to be.
Yeah, and isn't that flexibility? I know WeWork is taking a hit right now, but the co-working space could be something actually that benefits from this, because people are going to work from home, but they want a place to meet. They want a place actually that they can just maybe 2 or 3 days a week have a professional place. So that could be an area. But I personally am there's
a step above what most of us do, which is go to Starbucks and meet. Right?
Exactly. That's a great way to put it. Actually, it's listen, I have a place actually, Bridgeworks. It's in Long Beach, a local co-working place, and it looks like almost like a fancy coffee shop, but a lot bigger, a lot nicer, and professional meeting spaces. And to me, actually, I would rather go there for meetings, go there actually for doing actually any kind of things where I want to meet up with my team, and just work from home for the rest of the time. So yeah, we're just seeing things that are going to impact us in ways that we never actually would have thought actually we could be impacted, and we're also seeing we're doing things that we never thought we could as an industry, and handling the volumes that we never thought we could handle, and just dealing with unprecedented issues. So listen, I want to be a steward of your time, and we've been live for already 46 minutes. So first off, and before we wrap up here, I got to make sure. So you share a lot of information on your social profiles. So right here, make sure you if you're on Twitter, if you're one of the people that tweet, follow Rick on Twitter. Shares a lot of great information. I'm on your Twitter feed. I've gotten a lot of information, from your Twitter feed, that people think I'm an expert because I'm sharing the things I'm getting off of yours. So thank you for helping me become like an expert. And if you want to connect with Rick on LinkedIn, there's his LinkedIn address. So and listen, I'm just gonna wrap this up. And anything you want to say in closing?
No, just keep the faith. We're all going to get through this together. Change sometimes is good, but I do think that at the end of the day, we come out of this stronger as an industry, and hopefully as a country.
Yeah, amen. Thank you so much, Rick. I really appreciate you joining us. Thank you so much. I'm going to wrap up here, so just stick around for just one moment. So listen, I again, thank you so much for joining us for today. We've got actually some other great guests coming up next week. I mean, this has been a lot of fun. I feel blessed to have guys like Rick join us. So next week, Barry Habib on Monday. I mean, it doesn't get much better than Barry. Barry has been, just been actually a person that's been at the epicenter of this, has been sharing us, as an industry, guidance, has been interacting actually, with actually the Fed, with our government, talking to them to help them understand what's going on, with the forbearance. So that's Monday. Barry also is going to be great actually telling you what to say to your clients, how to actually how to have the conversation about forbearance with your clients. And also, Barry just somehow always finds actually opportunity for you to be excited about. So join us Monday, 4 o'clock. Then Tuesday, Carl White. Carl White's going to help you actually, what do you say actually, when you're dealing with borrowers right now, and how to actually, use this time to actually build your business. So Carl White's going to be on Tuesday. Wednesday is going to be Mike Tedesco. Mike Tedesco, you guys probably know him from Appraisal Nation. He's an amazing guy that's going to talk to us a little bit about values, talk to us about what he's seeing on the front lines. So that's going to be Wednesday. And I just got the official word. Joining us on, hold on for a second. Let me make sure this is the case. Yep. Okay. So 4 o'clock, by the way, these are all Eastern times. When you're from New York, that's all that matters, is just Eastern times. But 4 o'clock on Thursday is going to be Glenn Stearns going to join us. Glenn Stearns just recently started up a mortgage company, which, I mean, what a great time to start up a mortgage company. I mean, really, actually, it's a great, really a great time. So Kind Lending, Glenn Stearns is going to join us on Thursday. That's 4 o'clock, 1 o'clock Pacific time. And that's about it. So we're going to wrap this up. If you want to catch other episodes, use that URL on the bottom. That's scrolling by right there. And you can catch actually previous episodes. And thank you for watching. I'm Andrew Berman from National Mortgage Professional Magazine.